Morning, everybody. May I invite you to settle down? I'm sorry that some of you arrived at 8:45 and had to wait 15 minutes. I think there's a little bit of confusion as to whether we were beginning at 8:45 or 9. And so we chose to begin at 9 because I knew there were others still having breakfast. But thank you for being here on a Sunday morning. But I guess it's working day in Bahrain, but for many of us, mentally, Sunday is a day of rest. So thank you very much for being here. We begin the working part of the conference with a focus on the global economy. We have three very distinguished and experienced speakers who think about the world economy morning, noon and night in different parts of the world. And I'm sure when you have someone from Goldman Sachs, the original authors of BRICS, and someone who has been an economist editor, and someone who's making a money trying to sell opportunities in the Middle East. We have people here who have their feet on the ground and their hands very much on things as they move. So you're going to hear from this panel this morning on their perspective on the global economy. Our first speaker is Hugh Pill, who is the Managing Director of Global Investment Research Division at Goldman Sachs. He'll be followed by Bill Emmett, who is also a trustee of the IISS, but also a former editor of The Economist. And our third speaker is Dr. Alia Moubayed, as the Head of Research for the Middle East and North Africa at Barclays Bank. Hugh.
So good morning everyone, and let me say what a great pleasure it is to be here and what a privilege it is to be part of such a distinguished panel. So we have been asked to speak on the global economy, and we've been given 10 minutes to do so. So it's a little bit of a tall order to have a comprehensive view of developments in that context. So what I thought I would do by way of kicking off the session is just say a few words about how we have got to where we are, and then talk a little bit about what we see as the four key themes for developments in the global economy in 2016, and then conclude with just highlighting a number of issues that I think will govern the way forward from there. So I've spent the last 4 years, and only the last 4 years, working at Goldman Sachs in my current role. And in each of those 4 years, the house view has been global growth last year was 3%. We forecast global growth this year to be 3.5%, and we forecast an acceleration of global growth to 4% next year. And in each of those 4 years, we've been disappointed. Global growth has remained glued to this 3% level. And indeed, although things are a little bit brighter in 2015, we've been forced to sequentially revise down our forecast for global growth to only slightly above 3% this year. Now, in each of those different years, the specific reason why we've seen less growth than we expected has been idiosyncratic. In the earlier part of that period, there was the unexpected weakness in advanced economies stemming from the problems in the financial sector. Then in 2011-2012, we had the specific problems of the sovereign debt crisis and the banking crisis in Europe. And then over the last year or so, we've seen an unexpectedly strong slowdown in China, which has spilled over into other parts of the emerging world. But while each of the years has had a specific reason, I think it's important to keep in mind that there's a broader commonality throughout this period. And I think the broader commonality stems from the fact that we are still living through, even 7 or 8 years on, we are still living through the aftermath of the financial crisis of 2007-2008 at the global level. We're facing a long balance sheet recession where the efforts to correct the previous financial excesses that accumulated over a very long period, building up to their culmination in the financial crisis, constitute a very significant headwind to global growth. So having to recapitalize financial institutions, having to delever the private sector, having to improve governance in the financial system and more widely, all of these necessary and probably healthy things to do in the medium term from the point of view of the global economy, in terms of how they play out on a year-to-year basis, have weighed on growth and have weighed on recovery. So we're seeing a series of adjustments, a series of crises, if you like, that are the catalyst for adjustments, first in the Anglo-Saxon world, then in Europe, and I think now increasingly in the emerging world. The weak growth we've seen, and of course associated with weakness in commodity prices, which I'll come back to in a moment, this has also led to an environment of very low inflation. So this has created an environment where central banks have been in the forefront of trying to address the weaknesses that I've just described. In the first instance, central banks in the advanced economies took a key role in preventing a wider disintegration of the financial sector. And subsequently, they've played a key role in sustaining demand in the global economy. So I think central banks have become a focus of developments, not just economically, but also in financial markets. So in my day job, talking to clients about developments in developed financial markets, increasingly, unfortunately for me, given I used to work in central banks, I think the focus has been what are the central banks going to do and what implications does that have for the pricing of financial assets, rather than what are the fundamental drivers in the economy and how should they be reflected in financial pricing. So the next few days and weeks, I think, will be quite seminal in this regard, because we're about to face a number of changes in central bank policy that I think will have quite significant implications, both for financial markets and through financial markets for the broader economy. And that's basically the first key theme that we see in looking into 2016. That key theme is the prospect of a significant divergence of monetary policy outlooks across the advanced economies. We expect the Federal Reserve to finally start raising rates and begin to normalize interest rate policy, starting with a hike of the federal funds rate coming in December. At the same time as we expect the European Central Bank later this week and the Bank of Japan before the end of the year to do another leg of easing, another leg of asset purchases, and in the ECB's case, most likely further cuts of interest rates into negative territory. I think this is going to lead, first of all, pose questions for the ability of the financial system to absorb such divergence, which we haven't seen for some time, and we haven't really seen in the context of the new institutional arrangements in Europe. We expect that to lead to a substantially stronger US dollar, substantially weaker euro, and we expect financial conditions in dollars, which have been very easy for a very long time and have helped to support dollar financing in other parts of the world, to gradually become less generous, with implications for the funding of both companies and the public sector in other parts of the world. That's associated with our second key theme for 2016, which focuses around developments in China. We're not in the camp that China will suffer a hard landing. We do think that some slowing of the Chinese economy, an adjustment in the Chinese economy away from a dependence on very aggressive investment and exporting to the rest of the world towards a more domestic-oriented, more service-oriented economy is both necessary. An economy the size of China can no longer just rely on external demand, but also, as a result of necessary, also healthy in the longer term. But of course that adjustment does come with risks, particularly in a situation that I've described. There's a lot of leverage in the system, a lot of credit in the system, which needs to be managed and controlled. We think that the Chinese authorities do have the firepower and the ability to manage that transition. So we're not in the camp, as are some of our clients, that we're about to see a very sharp and somewhat catastrophic adjustment in China. But nonetheless, that slowing, that adjustment, does come with some risks. And we think that's one key theme, how those risks are managed. The third theme, which I think is of particular relevance in this part of the world, is our view on commodity markets, especially oil. So we have sort of taken up the talk of rhetoric of a new oil order emerging. That new oil order is based around the technological innovations which have made shale oil really the marginal pricing area for oil in the global economy. That suggests to us that we are going to see permanently lower oil prices because with the technological advances we've seen in this sector, the ability of the shale sector to produce oil at a marginal cost of around $50 to $55 a barrel will provide a sort of ceiling at which international oil prices can go. Of course, oil prices are more or less slightly below that level now, and we do think there's a question about how we go from where we are to a new steady state where oil prices are more stable around this level I just mentioned. I mean, our base case is that we are likely to see some fall in oil prices, but a relatively modest adjustment going from where we are to more stability in 18 months to 2 years hence at around that level. But I think there are sort of two key questions there. First key question is, given the excess supply conditions that are existing right now, could we see, and this is a variant scenario from Goldman which has achieved quite a lot of prominence in the press, could we see a sharper fall in oil prices in the shorter term down to $20 a barrel or so? And I think there is a risk of that, and that has implications both for this part of the world and others. But also, I think it's also important to keep in mind that the pace of technological change in this sector is very, very high. So my colleagues who now argue for oil prices stabilizing at $50 a barrel, 2 years ago were arguing for oil prices stabilizing at $80 a barrel on the basis that that was the marginal cost of producing oil in the shale sector. So if we're seeing a pace of technological change of that rapidity, who's to say it cannot continue further and lead to yet lower prices down the road? Of course, low oil prices both support real incomes and demand in oil importing countries, in Europe notably from my perspective, but clearly they also weigh on the oil producers, and that's a theme which no doubt will be important here. And that brings me, I think, to my final theme for 2016, which picks up a little bit on the reference to BRICS. Talking about the outlook for emerging markets. So I think there are a number of the themes I just discussed feed into what can happen in emerging markets. Dollar funding at the global level is going to become tighter because many emerging markets remain on some form of dollar standard. And of course, in this part of the world, countries are pegged to the dollar largely. Commodity exporters, especially oil, especially if they are financed externally using these dollar markets, I think they are vulnerable to the combination of weaker oil prices and a stronger dollar and tighter dollar-based financial conditions. Whereas others are in a more favorable condition, emerging markets which are importers of oil and are not reliant on external markets for funding, have current account surpluses, they may benefit from the same improvements in real income that lower oil prices provide. So as has been said, a decade ago or 15 years ago, we talked about the BRICS and we talked about this rising tide in emerging markets that would raise all ships. I think now we emphasize that in the emerging world there's going to be more discrimination. You can no longer talk about a single theme across all emerging markets, but you need to look at them one by one, discriminating on the basis of the issues that I've discussed. So these are the four kind of key themes that we've identified for 2016, and I'll leave it there, but just reflect before I finish by saying that, of course, these specific themes for 2016 reflect broader influences in the global economy that are much more long-lasting, and perhaps these are things that we can pick up in the subsequent discussion. So let me just list what I see as the most important. The first, which I think I haven't really mentioned so far, is on the demographic side. Many parts of the world are going through very significant demographic changes over the next decade or so. I think they will have significant implications. That interacts with big changes in geopolitics. So sitting in Europe and seeing the implications of what's going on in the Middle East in terms of migration, which has both a geopolitical dimension and a demographic dimension, that will be a key policy challenge for various parts of the world, I think, going forward. That's one aspect of the broader theme of globalization, which of course has been a mantra of people in our world for the last 15 or 20 years. But the nature of globalization does seem to be changing. It's no longer about integrating China into the global economy. It's about managing China's place as a more developed market in a global economy. And sitting on all of that, and something that I think is the most difficult to predict, and this is specifically true in the oil sector but has more general ramifications, is the pace and nature of technological change, of which we can all obviously benefit from. It all offers an enormous opportunity, but potentially has very big implications for the distribution of income, both within countries and across countries, in ways that I think will have important macroeconomic and political implications. Thank you very much.
Thank you, Hugh. Those of you who weren't woken up by a morning coffee would surely have been woken up by those interesting remarks on the global economy. A stronger dollar, weaker euro, risks with China's slowing down, lower oil prices, that's a wake-up call, and of course enduring structural shifts in the global system. And thank you also for sticking to your time. That's brilliant. Bill Emmett.
Thank you very much, Sanjaya, and thank you all for being here and having me here. Like you, I'm going to talk, of course, about the global economy as a whole. Unlike him, I think 10 minutes is a favor, because when you're really being asked to make forecasts about the future, I would say the right answer is the shorter the better, because we'll be disproved quite soon. Sam Goldwyn's mantra of never forecast, especially about the future, is probably the best piece of economic advice anyone has ever given. We are at a time when much of the mantra is about a slowing global economy. It is, as Hugh suggested, paradoxical that this slowdown at a global level coincides with the near certainty that the Federal Reserve will raise interest rates this coming month. I think what this should tell us is that looking at the global economy as a single entity is misleading. This is something that's really only been a habit of analysts for about the last decade, and I would say it is particularly a consequence of a certain self-flagellation tendency in the Western world, in the developed world, trying to console ourselves with rapid growth in China and the BRICS, to produce, therefore, more positive views of the global economy than our own economy seem to be suggesting, sometimes even inflating it by adjusting for purchasing power parity, which really should not be used for international trade and exchange. But that said, I think that to get a better picture of the globe, we really need to divide it into at least three parts and look at them quite separately, because what we're seeing is, in the developed world, America and Europe in particular, as Hugh said, a recovery following the adjustments that have taken place in the 7 years since the financial crash, and a recovery that is benefiting and will continue to benefit from the big drop in energy prices. That is like a tax cut for oil-consuming countries. It's a reallocation of demand and economic potential, and that reallocation is, or should be expected to be seen in the growth rates of the oil-consuming countries over the coming years. with the US and the UK both growing at more than 2% a year, much of Northern Europe also, particularly Scandinavia, following suit, and the Eurozone recovering from its very stagnant base, I think we are and can be forgiven for feeling that this is a secular upswing in the developed world. The big question for the developed world is whether wage rates, whether earnings of employees will now start to rise. The Federal Reserve's decision to tighten monetary policy, which will be followed at some point by the Bank of England over the next 12 months, is in part an effort to normalize in order to improve the allocation of capital, to restore the role of credit pricing, but it's also an acknowledgement that as labour markets tighten, so wage inflation should be expected to return. The fact that it's been slow to return, and we have watched Japan, seemingly at full employment, not see a rise in wages, has, I think, fueled the speculation that the Western developed countries might be in a period of what former Treasury Secretary Larry Summers terms secular stagnation. A long period of stagnation fueled by demography and the aging of populations, encouraged by the boom in technological innovation, which is seen to be hollowing out the mid-skilled, so-called middle-class parts of the population and redistributing labour demand towards lower-skilled, lower-paid ends of the spectrum, and that could therefore produce a very long period of anemic demand, which is what we've seen in Japan. Now, as that is a matter of forecasting, it's not really sensible to make a single definitive judgment about whether or not Larry Summers is right to be warning of this, or whether he's just being impatient about the recovery from a humdinger of a financial crash from 2007-2008. My bet, for what it's worth, is that he's being over-pessimistic, that actually time is going to be the great healer of at least those economies that don't have a severe aging or shrinking population pattern, and that wage rates will begin to rise. The long-term idea that technological innovation of the sort of pace that we are seeing in the energy sector, as you said, in biotechnology, obviously above all in information technology, that this could coexist with low levels of investment and the so-called secular stagnation seems to me to be at the very best unlikely. It seems likelier that although this technological innovation is often less capital intensive than in the past, rather that this will coexist with a new period of growth, suppressed by demography, but not snuffed out altogether by that. So the first part of the world I'm more optimistic about. I think that the developed world is hitting that point where wage rates will start to rise, household consumption will start to push along growth, and we will see a sustained growth there everywhere except where populations are shrinking. Second group, definitely China. As you said, I believe the right way to look at China is to compare it with Japan, to compare it with the Japan of the 1970s. Japan entered the 1970s with a big surplus of exports, with an economy that had been driven overwhelmingly by investment in urbanization and heavy industry, that had the dirtiest city air and water of anywhere in the industrialized world, and that had been benefiting from an artificially cheap currency. thanks to the oil shock of 1973, but also the Nixon shock of the break of the Bretton Woods exchange rate system, Japan in the 1970s made a rapid adjustment to a greater energy efficiency, to a clean environment with its first environmental laws, towards a higher technology form of industry, and towards some growth of services. And that is the adjustment that I believe that China is undertaking now. It's an adjustment that Chinese leadership has been talking about at least since 2007, when Premier Wen Jiabao talked about China's economy being unsustainable, unbalanced, unstable, and another un that I've forgotten, the four uns. And I believe that that change is underway. It's a slow change. China has a lot of misallocation of capital because to rescue itself from the global financial crash, it did produce a credit boom, and it has more political obstacles to change, to evolution, than Japan did in the 1970s. The power of interest groups, particularly within the state-owned enterprises and the more monopolized sectors, is great, and there is a contradiction between the political policies of President Xi Jinping, which are to centralize power and to crack down on corruption and to strengthen the steering role of the Communist Party, and the adjustment imperative in the economy, which is about dispersing power, about liberalizing new sectors and enabling the private sector to create the next China. So I think it's going to be slower and more difficult than was the case probably for Japan in the 1970s. But like you, my forecast is that it will nevertheless happen. China will adjust to being a more service-led, more higher technology economy. It will not give up being a heavy export economy, just as Japan has never given up being an export-oriented economy, because it has a surplus of investment over savings, which produces a natural current account surplus. So I don't believe that China will cease to be an export superpower, but I do think that over the long term we should expect China to make the Japanese-style adjustment, with bumps, with difficulties, but it will happen. And then the third group, just to put a bit more detail on, was the emerging economies, which will be the next session of this event, so I don't wish to talk in too much detail. Commodity producers, you are the experts on, not me. I think that we have to think about most commodities as being essentially a 5 to 10 year cycle, thanks to investment cycles. Shale does shorten that cycle in some parts of the energy sector, but I don't think it abolishes it. And so I think we have to think of this being a long down cycle that will, in the end, produce a new upcycle, but it will take a long time. The most important place to focus, though, is in the highly indebted current account deficit emerging economies, which certainly includes Brazil, Turkey, Malaysia, these sorts of economies which are not so clearly commodity exporters or versus importers. They have a more mixed economy, but they don't have strong defenses against excess debt, against financial problems. And I would say what also puts them together is a certain rigidity in the political institutions. So that while I would be optimistic, of course with Chairman Baru here, about India and about some of the other countries of Southeast Asia, I think there's not a good reason to be optimistic about Brazil, Turkey, Malaysia, countries where the political adjustments are proving so difficult. Because finally, I think as an economist or as an economic journalist, I think we have to acknowledge that the big questions about the future in the course of global or regional economies are almost always really determined by politics. They're not simply economic questions. the politics of domestic political institutions, whether they can be flexible enough to permit the evolution of an economy from one model to another, from one emphasis to another, and, above all, the peace and stability of geopolitics, which will determine the openness or otherwise of the theme that we call globalization. Globalization is threatened. It's threatened in Europe by the crises of terrorism and of migration that are combining in political minds. That's threatened also in America, although one has to always aim off during a presidential campaign, especially when Donald Trump is one of the candidates. But it's threatened also in Asia, where disputes over the South China Sea do have the potential to inflame and push back the degree of openness that we've seen. So there is a high level of political risk hanging around the global economy. If there were no political risk, I would finish my speech with a very optimistic view about the next 10 years, that politics exists. Thank you.
If there was no political risk, we wouldn't be here.
Exactly.
So that's one reason why I would certainly appreciate the downsides that you emphasize. I think after 2008, all of us have to be warned that while the future may be bright, there can be bumps along the way. Alia Moubayed from Barclays Bank, London.
Okay, thank you, Dr. Baru, and good morning, ladies and gentlemen. It's a great pleasure again to join this distinguished events that the IISS Middle East is trying to engage us in, both as analysts from outside, but also as myself as a citizen from this part of the world, trying to get a better understanding of both the outlook and the risks involved in the region. And Dr. Baru asked me today to focus on how the global trends that just Hugh and Bill has just outlined for us, how do they impact the Middle East and North African economies? What do these trends, whether in the short or long term, mean for our part of the world? And to what extent do these pose challenges or opportunities for businesses in the region? I thought a little bit hard to try to find sort of a storyline or a catchphrase, and the best I could come up with, I haven't particularly listened to Hugh and Bill now, is that certainly the region is caught between a rock and a hard place, and that is at different level, both in terms of its the challenges externally that it faces, and the domestic realities that constrain the ability whether to reform or to adapt to these external challenges. It's also in a difficult position because there are tensions among that is starting to arise in the region about the imperative for reform becomes even more pressing, and policymakers are actually faced with the realities of and the difficulties of effecting change. But I guess even more when we get to the policy level, and particularly in economic policies, we are starting to see in the region increasingly sort of this resurfacing policy trade-offs that these same policymakers are facing in terms of which way to move forward on reforms and the cost of these reforms, and how gradual or abrupt should these be made. So let me start a little bit first by looking at these external challenges and how do they interface with the domestic difficulties. I think I don't want to repeat that on the external front, the stagnating or not so exciting growth outlook in developed economies, what you call the long balance sheet recession, amidst again a fragility in emerging markets that speakers have emphasized, constitutes a very challenging backdrop for Middle Eastern economies, particularly because of the demand for commodities that this part of the world in particular is exposed to, but also in the limitations on the capacities for policy easing when we look at the region and see that most of these economies have fixed exchange rates and therefore their monetary policy is constrained by long-standing policy choices that are being challenged increasingly. Of course, also the policy normalization ahead of the Fed liftoff constitutes also a challenge for these economies, particularly for oil importers, where many of the countries are still facing large and widening external and fiscal deficits, and the need to attract capital flows and compete with other emerging economies makes that backdrop even more difficult. Again, on the external challenges, the slowdown in China, but also the long-term changes that the growth model in China and its implication on commodities demand constitutes a main changing element in those external forces that will shape the future of the region. So not only are we looking at what do we do after the end of the commodity super cycle, but also what do we do in the long term in Middle Eastern oil exporters, when actually the nature and of the demand for energy starts to change at a structural level. Needless to talk also that geopolitical risk, although one could look at it as an external factor, but it's very much embedded also in our domestic realities. And that brings me to the three themes that the region also is grappling with domestically and that will shape both the short-term and the medium-term outlook. The first theme for me is this whole issue of political instability, the challenge of security that is creating a lot of volatility and hampering inflows of capital towards the MENA region, which I'm sure you all know that it's the region in the world that attracts the least private flows in all emerging markets. Political instability, but also deepening fault lines across various levels, from sectarian to political Islam versus secularists, to all sorts of dividing lines that have made much of these societies prone to instability and higher political risk. So that's the first theme that we are grappling with domestically. But the second theme is also what was talked about, but which is of different nature here, is the demographic factor and what that means for both challenges and opportunities. Challenges because, as we all know, the demographics are biting in this part of the world. The population today is around 260 million, rising to around 500 million in the next 50 to 60 years, with 60% of the population less than 30 years old. Youth unemployment is almost 4 times higher than the average unemployment across the region, which all impose this dynamic, imposes the fact that there is a need at least to create 100 million jobs between now and 2020. And even 130 million if we are looking at increasing the participation of women in the labor force. Add to this demographic dynamics, of course, is the rapid pace of urbanization and rural-urban migration in the region that adds to these biting demographics and the needs for policy to follow these fast and growing challenges. And the third theme, of course, I will not also go into the details, but also is the domestic challenges first by the long-standing structural deficiencies in the region, from low productivity to high levels of poverty and inequalities, budget rigidities across the region, and we can go on. So it is this basically very tough and still challenging external environment that is facing this very sort of also complicated and pressing domestic realities. So how can the region deal with those external and domestic challenges, and what that means for the macroeconomic and political outlook? I think that certainly, of course, I think in the short term, it is very difficult to be extremely optimistic, because the difficulty of policy to act very quickly to deal with these realities would mean that these existing domestic vulnerabilities that I just hinted at, and not of course across all the region, but particularly in the most vulnerable countries, are likely to deepen And I cannot but talk about basically, for example, the risk still of slowdown in growth as a result of remaining persistent conflict in a large part of the region. Add to that the low oil price that will also sort of moderate growth in the low exporting countries, in oil exporting countries. And this means that for a long time, at least in the next 2 years, 2016-17, we are likely to see growth coming down from a 6-7% average that we have seen over the last decade to around basically a 3 to 4%. And that is obviously not something encouraging for adapting to the new entrants into the labor force. In the short term, also, fiscal and external surpluses of oil exporters will shrink significantly. We are moving from average of surpluses of 12 to 13% of GDP to fiscal deficits of around 13% on average in oil exporters, and another 2% of current account deficits across the region. What does that mean is that this part of the world, despite the accumulated surpluses of the past decade, will start to become a demander of external financing as opposed to an exporter of capital to the rest of the world. And that, in an environment of policy normalization, will also impose additional tightening of liquidity within the domestic banking system, something that the GCC countries are starting to see given the large fiscal deficits that many of the countries are facing, and an erosion of their buffers slowly that they are tapping in order to attend to these large and fiscal and external financing needs. The strengthening of the dollar also in the short term will mean that the competitiveness, particularly of some of the oil importers, I have in mind in particular Egypt, will suffer extensively. And this is where a large country like Egypt, which already is suffering from a very acute, almost full-blown balance of payment crisis that so far has been sort of prevented by the large and consistent support from the Gulf countries, is sort of facing the wall in terms of hard policy choices that it has to deal with when it comes to its exchange rate policies and the cost that implies for inflation domestically and for political stability. Iraq also is another very difficult and challenging in this environment, and risky, has a very risky outlook as we look at it from a global market perspective. And its importance is not only relevant, of course, for the stability of global oil market, as Iraq is the largest country that will be able to add in the future most supply to the global supply of oil in the future, but its ability to do so in a context of a very deepening and severe financial crisis that could affect investment in its oil sector, but also cause a sharp devaluation of the currency and an inability to attend to fiscal needs amidst basically a security and failed institutional backdrop, raises risk significantly when it comes to Iraq and its implication for security and spillover onto the rest of the region. So in the short term, I mean, I think the risks are very high, and that requires, of course, puts the emphasis on the need for adopting a much more different business as usual approach to policy reforms. These challenges and the risks that they have entailed certainly have pressed many governments to start sort of rethinking the business models that they have. It is very encouraging, actually, to see the rhetoric and the policy dialogue that we are seeing in Gulf exporting countries about the need to question past policies of complacency with periods of high low oil prices, and the failed policies to a large extent of diversification, particularly of external and fiscal revenues. And the movement, even though shy, but at least in the policy debate, for us, looking at it from a market perspective, is somehow encouraging to see, particularly in Saudi Arabia, but also yesterday hearing from the minister about Bahrain, and also seeing sort of the pioneering actions that UAE has taken about some of the acceleration of the economic diversification measure and the support to the non-oil private sector, whether is it by revamping competition-related policies and regulatory framework, liberalization, talking about liberalization of services sector. We're hearing liberalization of transport and services in Saudi Arabia. That's very encouraging. Expanding privatization and public-private participation, and the question yesterday was spot on the need to move ahead with these things. But I guess also sort of the taboo issues of talking about the need to start thinking about revenue-enhancing measures that could have important impact on redistribution of wealth within those countries is also encouraging. Of course, the proof will be in the pudding and the ability, not only in the willingness and the rhetoric of reforms. And I think that's what financial markets are trying to look for actions on. And it is needless to remind you, at least for those of you who follow financial markets, that there has been a significant repricing of risk towards the GCC region. The latest being, of course, the Bahrain coming to the market with a much wider higher cost of borrowing than usually has. And that reflects this perception of not that people now are not only looking at where oil prices will lie, but on whether governments will be able to implement those reforms. So does that mean that business opportunities are not it's not time to think about them? I think it's exactly the contrary. I think every risk and every period of difficulty breeds or creates the opportunities for businesses. And I guess, having talked about a little bit the backdrop of the challenges we're facing, I can maybe outline maybe 4 or 5 areas where I think there could be business opportunities, and I'm sure this will be more discussed in the future. I think first the whole aspect of sort of this geographic shift towards Asia, moving eastwards, and the importance of anchoring Middle Eastern economies in high growth regions, where they are naturally already have stronger ties with Asia, China, but also in Africa. We are seeing increasing opportunities, whether on the logistic fronts, trade and transport, manufacturing, and embracing sort of the value chain manufacturing processes. Morocco is a very interesting case, trying to do this, integrating more in Africa, but also the UAE, and I guess we heard yesterday about Bahrain, and much of the GCC is trying to strengthen sort of bridges with high growth India and the rest of Asia. Another area is, of course, the whole issue of infrastructure and its importance for job creation. The World Bank report last year, I think, has outlined that there is more than $200 billion of needed investment that could create more than 2.5 million jobs in the sector. And if we believe that pressures of urbanization, rural urban migration, refugees crisis now will require huge investment in those sectors, that's certainly a winning sector. But also let's not forget climate change, which is the topic of this week, I think, in Europe. And we all know that this region is one of the most starved in water that could be a future source of conflict. And I think, again, the Gulf exporting countries have been on the forefront of investing in all of the technology for water desalination, renewable energy, but more can be done also in all processes of water management, etc. So that's certainly another sector. Of course, I don't have time, but I guess also we should remember that in those times where, if Hugh is right, that oil prices could actually go lower, and that this part of the world will become increasingly more reliant on financial markets to fund itself. We have to remember that this is the region where financial markets are one of the least developed, despite all what we see of a strong banking system. The ability to mobilize domestic savings is still very limited, because we don't have deep and strong government debt and corporate markets, particularly in local currency. That's a huge area of reforms that can open up a lot of opportunities for businesses and cooperation. So I'll just end on just saying saying that there's certainly a lot of challenges. The choices of policymakers are certainly difficult, but I also see that opportunities abound. I think what we need to look at is domestically at the willingness and the ability to implement reform, regionally at also the willingness to put certain sort of divides aside and work more on regional cooperation within the region, but also with our neighbors in Asia and Africa increasingly, but also more at the multilateral level, probably challenge some of the multilateral institutions, and particularly the IMF and the World Bank, in terms of their approach to the region, at a time where over the last 4 years we have seen that those who have funded externally the large needs of oil importers were the oil exporters, and the oil exporters today are in a much difficult period to continue on that front. So there is a need also for a rethink of the multilateral approach to funding the region and supporting it in its growth and development. Thank you.
Thank you, Alia. I'm not going to summarize you in the interest of time. 2 decades ago, we all heard the slogan, "It's the economy, stupid," and I think what we're being now told is, "It's the politics, stupid." Most of the problems that countries are facing have to do with domestic policies. We have time for a few questions. I request you to be pointed in your questions so that we can get a quick response. I begin with Mr. Francois Heisbrook.
Thank you very much. Thank you for the contribution of the panel. My question is going to be to Bill and to you, and it's about the China question. It may not be the economy stupid, it may not be politics stupid, it may be China stupid. Because I have cognitive dissonance here. Officially, China is doing 6 to 7% a year. In private conversation with practically anybody who knows anything about China, I am told that it's in reality 2 to 3% a year. Now that's a hell of a difference. 3% difference, year upon year. What does that mean? Because either you've already factored the real growth rate into your economic models, but I don't see very well how you do that without it showing up one way or another, or you haven't factored that difference in. And if it is 3% difference over a number of years, the knock-on effect on the global economy must be very substantial indeed. It's like having 1.5% of growth being withdrawn from the US economy a year, or ditto for the Eurozone. So what is the situation here? Am I overstating the case? Or am I understating it?
Thank you, Francois. The gentleman there. Yes, please.
Well, thank you very much, Baro. My name is Ran Zhongzi. I'm from China Institute of International Studies. First, I'd like to congratulate all the panelists for their very insightful analysis about the perspective on the global economy. However, I find one thing is missing, probably due to the time limit. That is the possible reform of the global economic and financial order. So I would be very curious for the panelists' views on what kind of anticipation you are going to expect for the possible reform of global economic and financial order. Thank you very much.
Thank you. Dr. Samitra Chowdhury.
Thanks. All the right things about the nice presentations. I got just 2 points. One, Mr. Pill, regarding the post-2008 regulation, do you think that there is a tendency to over-regulate the banking system both in Europe as well as the United States, especially considering the regulators did not cover themselves in glory in the 2008 crisis? They never saw it coming. The private people, that is the credit default swaps, did not default. The private guys got it right. And is this over-regulation going to be a problem going to the future, or am I completely wrong? Mr. Ahmed, I've got a brief question. You talked about the possibility of the West recovering, of job growth going up. As you know, there are data from the US Census Bureau which shows that real wage growth corrected for prices has actually not increased for the lower educated high school and high school graduates and high school dropouts from 1963. In 2008, they're back at 63 levels and they haven't really gone up. And the last 10 years, even those with an advanced degree are not showing real income growth. In combination with everything else, how do you look at that?
Yes, good morning. This is Abdul Khaliq Abdullah, Professor of Political Science from the United Arab Emirates. I guess the buzzword for most of the 20th century was the Asian tiger, followed by East European tigers, then there was Latin American tigers, then we have heard some African tigers. Do you see in the horizon any new tigers for the 21st century? Or is the 21st century going to be a century of rats and cats?
Thank you. Yes, ma'am.
Yes, please. Thank you very much. Salam alaikum. Good morning. First, many thanks to the panelists. I have a few short questions. First of all, what is your advice to the government in the area to stimulate the economy and work hand in hand with the private sector to develop the financial markets as well as the infrastructure? The second is, I have a question, and maybe you all can help me. While the prices are going down, and we all know of the supply and demand concept, why are the oil producing companies not taking a decision to reduce the production of oil so as to improve the prices? Now, I certainly know that oil countries here in the Gulf are fighting on two fronts, which consumes a lot of money. And that is one thing that I haven't heard from the panelists, that this is causing another stress, additional stress which we never had in the past. And this consumes a lot of money. So what we need really today, in my opinion, is first to stabilize the situation if possible, because war consumes a lot of money and this is extra stress on the governments. So then the last thing is the privatization. How can you give us just more depth? How can the privatization and liberalization of the market help to stimulate the economy and have a more slim and trim government, yet not to cut the spending to the level that it will kill the economy? Thank you.
Thank you. What I suggest, Bill, you address the specific question addressed to you from Samitra, as well as the one about global institutional reform. Hugh could say something about the next tigers or cats, considering you stuck your neck out on BRICS. And Alia would reply to the questions about the policy response of local governments in the region.
Okay, thanks. You've forgotten China, so I will also address China. I think to address Francois's question, I think you're probably overstating, or at least your sources are overstating, but not, obviously not hugely overstating. I think that the important indicator that one has to keep an eye on is unemployment. In other words, unemployment or underemployment, migrant workers fleeing back to villages, protests because of lack of jobs. We're not seeing that yet. We saw it and some worries about it in 2008 at the time of the global financial crisis. We're not seeing that yet. That says to me that even though 6.8 is, I'm sure, an artificial figure, things aren't as bad as the very low estimates that you're being told, and or to some degree loose credit is still supporting activity, perhaps more than expected. So the big risk on China is political instability. That comes when you have high unemployment and loss of opportunity. We're not seeing that yet. If we do, I'll start getting seriously worried. That's when I'll start getting worried. The effect on the world economy is not so big because China has a current account surplus. Statistically, it adds to global growth or subtracts from it, but in terms of actual transmission of demand, it doesn't unless you're a German machine tools exporter, in which case you're worried. But in terms of the global economy, it doesn't matter so much. Real wage growth in the US, I would say that certainly there has been quite a long-term stagnation, although the problem is with the definition of real. Or one of the problems is with the definition of real. It's not credible to think that living standards in the United States have not risen for the past 45 years. even if some statistical artifacts suggest that this could be the case. You just have to use the evidence of your eyes to know that that's not true. There's been a qualitative change. All sorts of new technologies, all sorts of innovations have come in which aren't captured by the inflation adjustment. So that's one part of the mystery. Also, America has had a substantially rising labor force, thanks to immigration and of course some recovery in the fertility rate. So I don't think it's as bad. We clearly have some difficulties of real income growth in the US, but I think those exaggerated. Finally, reform of the global economic and financial order. I suppose the first answer to that is a glib one, which is I wish there was a global economic or financial order in some ways, although as a liberal pro-market person, perhaps I should say I want disorder, I want the free market. What one really means is global institutions, the IMF, the World Bank, now the Asian Infrastructure Investment Bank, and I think that bit by bit the global financial institutions are coming to represent more realistically the reality of world economic balances, but not thanks to the US Congress, which is extremely slow at allowing this, or some degrees European politics, but rather to China setting up its own institutions. So I think we see that moving, but I don't see any order that otherwise can be reformed.
You?
Yes, thank you. If you allow me, I will also say just a few words on China. I agree with everything that's been said. To your specific points about how we do this, I think we have tried to use other indicators to construct a kind of underlying measure. These are very standard ones, looking at electricity use, etc. Those indicators are certainly lower, although they're not as low, consistent with what Bill said, as the numbers you quote. I think another important thing to emphasize is those indicators are also much more cyclical. So they do suggest that the slowdown is sharper than the official data reflect. And those are the type of indicators that are underpinning our analysis. Even though we formally forecast the official data, we use these underlying measures. And I would also emphasize, and perhaps this is something I didn't make very clear earlier on, is that it is easier to measure hard things than soft things. And if you think that the change that China needs to go through and is going through is going from making hard things to the softer services, etc., I think these traditional underlying indicators of activity will tend to underrepresent what's going on in China now. So a view of my colleagues in Beijing, in Hong Kong, is more sanguine than the view I get talking to a commodity trader in London. The commodity trader sees what's happening to the price of metals and extrapolates that to what's going on in China, whereas our economists sitting in Beijing see the developments in these softer parts of the economy which are harder to measure, both for the official statisticians but also for people doing our job. So that's one of the reasons why we're not quite in the cataclysmic camp, although we don't want to be seen as in denial of a slowdown in China, which is significant. Second question I want to answer is on the tigers and cats and so forth. I mean, first of all, as given my nationality and ethnicity, I wanted just to mention we have the Celtic tigers too. That was important to us. But one thing I would say is I think that we tend to emphasize, it's natural to emphasize, and the emphasis we placed in this panel on politics over economics leads towards this, the country-based analysis. Whereas I think the tigers of the future may as likely be technologically based as geographically based. So I think the future tigers might be in certain segments of the economy, and the dynamism of that economy may be less geographical, because actually it's a feature of the information age that it's harder to pin the most dynamic parts of the economy to a specific geographical location. That creates many complications. How do you tax these people? How do you ensure that they meet broader social responsibilities? And I think that probably is the right way to think about the tigers of the future. I have a feeling that all countries will look like cats relative to the tigers in that space. And then more specifically, and perhaps a reflection of that point, to the question on bank regulation. So, I mean, obviously, I work for and I'm a shareholder in a large global bank, so I have a certain amount of self-interest in answering this question. I'm not generally asked, aren't banks over-regulated? I'm generally asked, why aren't banks regulated more? So I think it was an interesting perspective that you brought. And certainly it's one that I think chimes with the views of my colleagues and I looking at the way the world is working. If you look at the behavior of financial markets of late, I think you see that financial markets are more fragile and more volatile as a consequence of the regulation. Now, regulators will say, and I think to some extent fairly say, that that volatility and to some extent fragility suggests that markets are learning how to price certain risks, notably liquidity risks, better than they did before the crisis. So before the crisis, there was some mispricing, and now we are entering a phase that maybe there's better pricing. Now, I think if you rely, and in this respect I think I'm as liberal as Bill is, if you rely on regulators to determine what the price of liquidity should be, it's not clear they will always get it right. And I would certainly be in the camp of saying maybe this process has currently gone too far in the opposite direction. I think it's a reflection of the primacy of politics, which has probably been one of the themes that we've had here in this panel. Given the events of 2007, 2008, given their consequences both in terms of the macroeconomy and in terms of distribution, it's not surprising we see, if you like, an overreaction. And the question is, how costly is that overreaction and how far will it go and what its consequences will be? From my perspective, I think we're in a situation where banks function as an intermediary, as a market maker, is to some extent being compromised, and I think that comes with significant costs.
Right, Alia, just 1 minute for you to give a brief reply.
Yeah, I mean, on what the governments of the region should do in terms of sort of facing this sort of changing or the new normal of lower oil prices, I think increasingly really sort of promoting in a much more transparent way public debate about the difficult policy trade-offs that they are facing, and collectively basically come to a more open decision making of what are the revenue diversification choices we have to take. Do we tax, do we increase corporate or income tax, or introduce a VAT? I mean, choices will have to have sort of a debate about these choices on the revenue side, but also on the expenditure side, particularly when we know that almost half of their current fiscal deficit can actually be wiped out by a relatively gradual choice to reform subsidies, for example. So I think the more government should try to devise a sort of medium-term at least fiscal plan, they give visibility to the businesses, like Mr. Mash'al yesterday. I mean, I could see the tension between government and private sector. Of course, if I'm private sector, I see these deficits and I know, okay, how is the government gonna fund them? I need to see a visibility on what are the revenue and expenditure choices over at least 3 to 5 years, so that I make my my investment decision. So the greater sort of transparency and debate about those immediate policy trade-offs, the better it will improve business confidence in the sector, but in the oil exporting economy, something that we still don't have. I think, again, I mean, Saudi Arabia is the elephant in the room also here, particularly if we believe that they said to the markets they are going to come with a major sort of plan in January that explains what the kingdom will do in order to face the fiscal challenges and adjust to lower prices. If such an approach to medium-term planning starts to sink into the region, I think that could be a major game changer that could open up debates about the other choices related to privatization, which should be part of this medium-term fiscal strategy. I think this is where the focus should be in the short term.
Thank you, Alia. Thank you, Bill. Thank you. I think that was a very, very stimulating 1 hour. There are possibility of global economic recovery led perhaps by the United States. There are bright spots around the world, but commodity prices pose a risk, particularly to this region. On the other hand, of course, they offer opportunity for importers. Chinese economic slowdown, on which we'll probably hear a little more from Haihong in the next session. But China's economic slowdown is clearly a risk going forward into next year. And finally, how each of these countries, whether it's Europe, United States, China, emerging economies, Middle East, deal with policy at home is really what will determine the fate of the economy like next year. That it's all about, as I said, it's the policy stupid, it's about domestic reform and adjustment to a difficult global situation. Thank you very much. Ladies and gentlemen, as our panelists leave, I will be inviting the next session. So please do not get up. We'll go smoothly into the next session. And my colleagues will change the names on the dais. And let me request you all to give them a final hand. And the focus into our next session, focusing clearly on emerging economies and the implications of whatever is happening among emerging economies for the Middle East. I've already mentioned our three panelists, Dr. Felipe Larraín Bascunan, the former Finance Minister of Chile, Dr. Tayo Bark, the former Minister of Trade for South Korea, both of whom have been at earlier Geo-economics conferences, and therefore I'm delighted that you're again with us this morning. And Haihong Gao from Beijing, she